property investments have overwhelmingly been the preferred source of investment for particularly retail investors through Australia. And therefore, the levelling of the playing field through these proposed or possible tax changes make equities a more competitive and interesting space.
Welcome. Well, we don't have much longer to wait for the final details, but are the tax reforms as reported likely to change how Australians will invest on the ASX?
Look, we think they will, and the reason behind that is, although it doesn't necessarily improve the attractiveness of equities, on a relative sense it does. The reason for that is for the last decade, if not 2 decades, property investments have overwhelmingly been the preferred source of investment for particularly retail investors through Australia. And therefore, the levelling of the playing field through these proposed or possible tax changes make equities a more competitive and interesting space.
If that is the case, are the types of stocks investors are likely to favour going to change? Could investments motivated by capital gains become less attractive?
Look, from what we've read, the changes to the capital gains tax structure would make growth-type equities somewhat less attractive on an after-tax basis. No longer are you getting the 50% CGT discount that's been in place for quite some time. Now, what that means is not only is your theoretical after-tax generated earnings or profit from those investments no longer as high as it once was, it means also that income-type equities, so that is stocks that pay steady but high dividend yields, become relatively more attractive. So our broad 40,000-foot high view of this tax change would be that it certainly will shift and translate into a pivot away from growth equities and capital gainers towards income and dividend-paying equities.
If listed companies know investors are suddenly hungry for more income, does it follow that there will be implications for how businesses themselves are run?
Look, possibly. And we have a bit of a test case from that, and it's over 40 years ago. In 1987, the Australian government introduced dividend franking credits into the system. Now, preceding that period, the payout ratio from Australian companies was no different to companies around the world or in the US. That is, about 40% of the earnings were paid out in dividends. What's happened since then is because of the dividend franking system and the fact that investors, therefore, on an after-tax basis, valued dividends more, companies responded. And what we've seen in Australia over the last 30 years since that franking system was introduced is that companies in Australia, on average, have paid out between 60 and 70% of their earnings in the form of dividends. So a big structural step up. Now, we are not able to use a crystal ball in terms of how this will play out, the tax policies that could be announced tomorrow, impact on investments and preferences over the next decade or more. But we would suggest that investors should be mindful that a structural change could be in place, and therefore the motivation of investors and the way in which corporates respond could now change direction.
Does that mean eventually there could be consequences too for the economy if these companies are putting less towards investments, towards innovation?
Look, possibly. Long-term investors like the idea of growth because growth eventually generates strong returns, productivity and heavy capital gains. So I don't think any of the policymakers, and for that matter financial market professionals, would like the pivot to be too strong. But a shift in attitudes around returns would likely respond to tax changes, and the tax changes that we have seen mentioned as possible in tomorrow's budget would, at the margin, certainly shift attention more towards the relative importance of income over growth equities.
The founder of Wilson Asset Management, Jeff Wilson, has a different view to yours. He's asserting that the reform will discourage investment in both housing and shares and could drive capital overseas. How much of a risk is there that investors will look to overseas indexes as an alternative to investing on the ASX?
Look, it's always worth thinking about, but what we would point out is income growth and dividends that the Australian companies have been able to deliver and generate over the last few decades have been a big part of the total return of the Australian equity market. over the last 40 years, the Australian equity market on a total return basis has been one of the best performing equity markets in the world. Now, that's not because our index level rose as strong as other equity markets in the world. It's because of our income gains with dividends on top meant that your total return was very strong. So I don't think it necessarily lowers the overall competitiveness of the Australian equity market. Now, within these domestic borders, I think the overall attractiveness of equities actually increases under these proposals because property is no longer receiving the favourable treatment that it's had in place for so long. So what that means is, at the margin, investors, whether they're retail or institutional, will no longer have the same confidence that the property market cycle is this one-way directional up story that can't be broken. It may lose steam, it may head sideways, and that would shift an order in preferences and priorities amongst investors, and we believe that would be towards equities.
If you're right and investors do indeed move towards steady income streams over growth stocks, could you imagine the government revisiting the idea of taxing franking credits, another idea put forward by then Labor leader Bill Shorten in the 2019 election campaign?
Look, never say never, but at the same time, the fact that this budget to be delivered tomorrow is likely to address capital gains tax and negative gearing, but is not rumoured to be mentioning franking credits, would lead us to believe that policymakers have decided that at this stage and for the foreseeable future, that is not something that they want to tinker with.
Richard Shellback, good to speak to you.
Thank you.